Today, almost everyone is looking at the same headline and drawing the wrong conclusion. The price of Brent crude is down 44 basis points, a tiny 0.4%, sitting at $85.33. The small drop is being reported as a breather, a nothing burger. That silence is exactly where the trap is built. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I am giving you 2 scalp plays and 1 swing trade you can execute today, plus the 1 headline that flips everything. If you are watching without sound, keep your eyes on the screen. The level you must write down now is $82.89. If that breaks, the entire monthly structure resets and the trapdoor opens. On screen, you will see the numbers 82.89 trap, 2 scalps, 1 swing. That is your anchor for the next 15 minutes. The instant market verdict for Brent on this session is this: we are in a strong buy structure on the daily, 4-hour, and hourly charts, but the weekly is neutral, and that divergence creates a coiled spring. The session bias is a fade of the intraday dip, followed by a momentum breakout attempt. In plain terms, I expect an initial stop hunt lower before we rocket. The single invalidation level that flips this entire bias is a daily close below $82.89. Write that number down. If we close below $82.89 today, the bullish structure is violated, the 200-day moving average at 82.52 gets tested, and we are likely headed back to the March range lows. I want you to type 82.89 in the comments right now. Physically putting that number in your mind will save your capital. The herd, right now, is overwhelmingly positioned for a breakdown. I just looked at the retail positioning data. Almost 70% of small traders are short oil, expecting the geopolitical spike to fade. That sentiment reading is sitting at a sentiment extreme, and when you combine that with the fact that stop clusters are parked just above the weekly R1 resistance at 87.07, you have a textbook liquidity magnet. The smart money knows that if we flush the late shorts, those stops become the fuel for a melt-up. Let me add a freshly sourced data point that cements this. Just this morning, a major investment bank, Goldman Sachs, updated its short-term oil note, specifically flagging that they see a $90 Brent target within 4 weeks if the Iran military expansion narrative escalates beyond regional proxy activity. They are not alone. The order flow we are tracking shows that over $680 million has flowed into energy ETFs in the last 48 hours. The largest 2-day inflow since the initial shock earlier this year. That is not retail money chasing a headline. That is institutional rebalancing ahead of what they believe will be a sustained supply disruption premium. That matters because it adds a layer of sticky capital beneath the market that will not be shaken out by a 15-cent dip. So when you see price drift lower right now, you are not seeing weakness. You are seeing a gift. Now let's go into the technical deep dive. I am going to walk you through the chart from the weekly canvas down to the 60-minute execution frame, and I want you to visualize every level as I speak. On the weekly chart, Brent has just printed a large range bullish candle that closed decisively above the 50-week moving average for the first time in over a month. The weekly trend is officially neutral, but the structure is a higher low. We bounced at the 78.71 zone 3 weeks ago and have now reclaimed the 85 handle. What is critical here is that the 200-week moving average is sloping gently upward near 82.52, perfectly confluencing with the monthly S1 pivot at 82.89. That band, 82.52 to 82.89, is the floor of this entire quarterly setup. The weekly MACD has just hooked bullish, with the histogram printing a higher low while price printed a lower low a few weeks back. That is a hidden bullish divergence, a signal that momentum is turning long before price breaks out. Most traders miss this because they stare at the daily RSI and see only a 58 reading, thinking there is no urgency. But the ADX on the daily is at 47. An ADX above 40 with that divergence is not a neutral signal. It is a coiled beast. Dropping down to the daily chart, we are on a strong buy signal, and the moving averages tell a compelling story. The 5-day moving average has surged to 81.84, the 10-day to 79.37, and the 20-day is at 79.64. All three are stacking bullishly and sloping sharply higher. Price is now 30 cents above the 50-day moving average at 85.25, which is a crucial inflection. The 100-day MA is at 86.16, just below the R1 resistance at 87.07. So the zone from 86.15 to 87.07 is the real battlefield. If we close above that, the next stop is 89.40, and then 91.25. The daily MACD, while still negative at minus 1.93, is about to cross signal. The fast line is accelerating upward, and when you see a MACD cross on a 47 ADX trend, it usually triggers an acceleration. The CCI is at 172, confirming strong upside momentum, but the stochastic at 60 is holding in the mid-range, telling us we are not yet overbought. This combination is rare. It means the trend has room to breathe. On the 4-hour chart, the picture is even clearer for the short-term trader. We have a strong buy signal, and we have just broken a short-term descending trend line that had capped price at 84.50. The 4-hour MA20 is at 79.64 and sloping up aggressively. Price is over 400 basis points above that, showing strong separation. The 4-hour RSI is at 63, not overbought. The MACD is positive and still expanding. Here is what most traders miss at the 3-minute mark. The true hidden divergence is on the 60-minute chart. Over the last 6 hours, Brent made a higher high in price, but the 60-minute RSI made a lower high. That is a classic bearish momentum divergence on the very short term, which is why we are ticking lower by 44 basis points right now. This micro-divergence is precisely the trap. Algos see the divergence, sell into it, and the herd follows. But that divergence is occurring inside a larger bullish structure with an ADX of 47. This is a washout move, not a reversal. I call it a divergence trap, and it is the #1 pattern that separates winners from losers in strong trends. The smart money is using this tiny dip to reload longs at a better price, and I want you to be on that side. Let me give you the exact support and resistance grid now, conversationally. The pivot point for today is 85.22, and we are oscillating around it. Support 1 is 82.89, support 2 is 81.04, support 3 is 78.71. Resistance 1 is 87.07, resistance 2 is 89.40, resistance 3 is 91.25. The ATR is a massive $3.32. That means a daily range of over 330 ticks is normal. A $1 move is noise. The market can scream from support to resistance in a single session. When you combine that with the geopolitical heartbeat, your risk management must absorb that ATR, and I will show you exactly how in the trade setups. But now I need to connect the cross-asset linkage because Brent does not trade in a vacuum. The dollar index, DXY, is currently stalling around the 105 handle, struggling to break higher. When the dollar stalls, commodities breathe. Yields are not spiking violently. The 10-year yield is consolidating, which means the real yield pressure on gold and oil is easing. Meanwhile, the S&P 500 is trading with a defensive bid, and the VIX remains above 16, indicating a risk premium environment. Here is the link. Normally, a risk-off S&P would pressure oil lower, but when the volatility comes from a supply shock narrative, not a demand destruction narrative, oil and equities can decouple. That is exactly what we saw in the energy ETF flows anomaly. Money is rotating out of tech and into energy as a hedge against geopolitical escalation. This is the geopolitical heartbeat character of Brent oil, the asset that screams when supply chains are threatened. The correlation between Brent and Nasdaq futures has been negative over the last 2 weeks, meaning oil is trading as a safe haven against supply disruption, not a risk-on commodity. That is a crucial structural shift. For the 1 to 2 week directional lean, I am bullish above 82.89, with a target of 89.40 to 91.25. The exact event that invalidates this lean is a combination of 2 things: a daily close below 82.89 and a de-escalation headline that confirms the US is not expanding operations in Iran. If both conditions appear, we will take the swing off the table and sit in cash. But as of this moment, the news flow, the order flow, and the technicals are aligned for a supply premium repricing. I want your second interaction trigger right now. Do you think Brent breaks $87.07 before the end of this week? Comment yes or no in the chat. I am tracking consensus, and the delta between retail sentiment and the actual level matters hugely. If I see a flood of no, I know the squeeze is even more fueled. We are now entering the trade setup section. Most people skip this part. They think they already have the direction and close the video. That is exactly where the money is made. Keep watching. I am giving you 2 scalp strategies and 1 swing strategy, each with an exact on-screen trading plan card that you can screenshot. The numbers are precise, the stops are non-negotiable, and the invalidation conditions will keep you on the right side of the elephant. The first setup is the opening scalp, a high probability fast snipe for the London or early US session. This scalp is designed to catch the resolution of that 60-minute bearish divergence trap I just described. As I record this, Brent is pulling back toward the 85 area, just under the pivot point. I want you to wait for a precise trigger. Look at the 5-minute chart. The exact entry condition is this. Price taps 84.90 and prints a bullish engulfing candle on the 5-minute chart that closes above the high of the prior red candle. That tap and engulf signals that the sell stop run below the round number is complete. Your entry is an aggressive limit order at 84.95, placed immediately after that engulfing candle closes, assuming the low was 84.90. The stop loss goes at 84.55, just below the session low and well within the ATR noise tolerance. That is a 40-cent stop. Your first take profit is at 85.60. Which is a logical intraday resistance and just above the pivot. That gives you a 65-cent reward and a risk-reward ratio of roughly 1 to 1.6. If momentum pushes through, you can trail a second take profit to 85.90, right at the 50-day moving average confluence. This scalp is instantly void if the 5-minute candle closes back below 84.85, because that would signal the stop hunt has not finished and a deeper flush to 84.20 is likely. On screen, you will now see the precise trade card for the opening. Scalp. Entry at 84.95 after a bullish engulfing on the 5-minute that taps 84.90. Stop loss at 84.55. Take profit 1 at 85.60. Take profit 2 at 85.90. Risk to reward is 1 to 1.6 minimum. Invalidation if a 5-minute close occurs below 84.85. Now, the second scalp strategy is the liquidity grab, a counter-noise play using the 15-minute chart. This is for the faster execution trader. I want you to identify a clear stop hunt zone just beyond the current session low. We have a clear low from 2 hours ago at 84.65. There is a cluster of sell stops resting just below that, down to 84.50. The liquidity grab entry triggers when price makes a fake breakout, spiking below 84.65 and then snapping back above 84.65 within 2 15-minute candles. That snapback confirmation is your trigger. The moment a 15-minute candle closes back above 84.65 after the spike, you enter long at market, which should be around 84.70. Your stop loss goes just beneath the wick, at 84.35. That's a 35-cent stop. Your target is a fast singular exit at the nearest intraday liquidity pool, which is the pivot point at 85.22. That's a 52-cent reward, offering roughly 1 to 1.5 risk reward. This play is a classic market maker rebalance move, and it works best when the overall trend is strongly bullish. A word of warning, this requires fast execution and you must not hesitate if the snapback candle closes strongly. If the candle closes back below 84.65 instead, the grab failed, and you do not enter. Invalidation is a 15-minute candle close below 84.35. After this scalp, I want to pause for a community pulse check. Are you scalping or swinging this week? Comment scalp or swing right now. I want to see where this community sits because it tells me the collective time frame bias, and I will reflect that in tomorrow's video. On-screen graphic for the liquidity grab. Entry at 84.70 on a 15-minute close above 84.65 after a spike below. Stop loss at 84.35. Take profit 1 at 85.22. Risk to reward at 1 to 1.5. Invalidation if a 15-minute candle closes below 84.35. Now for the session swing, the real meat for those who want to catch a multi-day move. The session swing is aligned with the daily strong buy trend. The trigger condition is this: a 4-hour candle close above the 60-period moving average on the 4-hour chart, which currently sits at 85 even, with the MACD histogram showing a fresh bullish tick above zero. I anticipate this close will occur within the next 2 sessions. As soon as that 4-hour close prints above 85 even with a bullish MACD cross confirmed, you enter long at market, which I project will be around 85.30. Your stop loss is placed outside the daily structure, below the support 1 level and the 200-day moving average. That stop goes at 82.65. That's a $2.65 stop, reflecting the ATR reality. Do not use a tight stop here. The swing needs room to breathe. The conservative take profit 1 is at 89.40, the R2 resistance. That's a $4.10 move, giving a risk reward of 1 to 1.5. The stretch take profit 2 is at 91.25, the R3 resistance, for a total move of 5.95 and a risk reward of 1 to 2.2. Once price reaches halfway to TP1, which is around 87.30, I want you to move your stop to break even at 85.30. That locks in a risk-free trade. The invalidation that would shift the medium-term outlook is a daily close below 82.89, which is also our initial red line. If that happens, you exit the swing completely and preserve capital. On screen, the trade card for the session swing. Entry at 85.30 on a 4-hour close above 85 with a bullish MACD cross. Stop loss at 82.65. Take profit 1 at 89.40. Take profit 2 at 91.25. Risk reward at 1 to 1.5 and 1 to 2.2. Invalidation if daily close below 82.89. Do we need a quick but non-negotiable risk management pulse? Never risk more than 1 to 2% per trade. Scalps demand even tighter risk because you are dealing with noise. No positions through high-impact news events like the weekly petroleum inventory report or unscheduled White House briefings. Stops are not suggestions. They are the line between a trader and a gambler. This is how you survive to trade the next big supply shock move. Now we close the loop and lock in the retention trigger. Summarizing everything, the single most critical level for the next session is $87.07. A 4-hour candle close above that opens the floodgates to 89.40 and 91.25, and it will trigger a massive short squeeze because the herd is heavily short. The wildcard for tomorrow is the inventory data and any verbal escalation from Washington or Tehran. If the US formally announces expanded military operations, the supply premium will reprice in minutes, not hours. I will have the updated blueprint 24 hours from now, mapping the exact new invalidation levels. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq Gamma flip later. That binge sequence builds topic authority and keeps you ahead of every major repricing. Hold the like button and smash subscribe. Every signal helps the algorithm bring you the levels that matter before the crowd sees them. Please always remember, scalp the noise. Swing the trend. Let the levels guide you, and I will see you in the next alert.